Good morning and welcome to the Monday Market Update. My name is Nash Paradise, joined here as always by my good buddy Andrew Cady in sunny Florida. Andrew, how you doing this morning?
Oh, just dandy. We got ourselves a markets in the red. We got a lot to talk about today.
Yeah, there's nothing like asking how you're doing. I already know the answer there because you and me and every other mortgage, real estate, anything person who opened their phone this morning got excited, wanted to check on the bond yields, see where things are going in pre-market. Awfully disappointing when we got plugged in, but we will get to the disappointment. We'll talk a little bit about what's happening and why. Let's jump through here pretty quickly first on what went on last week because it has become completely irrelevant now. Not a whole lot to say on this other than, we're going in a good direction, got lots of good data, finished the week super strong. A lot of end-of-month trading and positioning that isn't necessarily reflective of, the data that was coming in. But anything else you'd add to what we saw last week?
I just think the markets performed phenomenal last week in the face of really, really bad PPI report on Friday. The markets held their ground and read right through the report that it was services increase, not goods increase. And unfortunately, we have war and the markets are not happy today.
No, they're not. Yeah, let's talk about what was on the docket last week because, like Andrew said, we absolutely blew through some massive increases Friday. Last Friday was inflation day. And, some of the biggest ones jumping out, the core PPI month over month, projected at 0.3, actually came in at 0.8. We did get some revisions. They didn't help anywhere on anything. Looking at the year over year, projected 2.6 came in at 2.9. So, I've seen some people so far this morning being like, inflation's going up. And like, if you look at it from a broad enough, window, it's that it's going down, but not quickly enough, not as quickly as we had been going down. Now it's getting that stability there. And honestly, Friday should have kind of crushed us on pricing and on the 10-year treasury bonds, but we did the opposite. So what do you do with that?
I think investors read through the report. Holiday season services are going to be up. They're going to be more expensive. I think there was some kind of underlying expectation that maybe the market wasn't quite going to get this report. And I think we'll definitely, now if we see another report like this on a back-to-back month where we don't have holidays in play, probably see some bad market reaction to it. Maybe the markets just shook it off as a one-off report.
Yeah, and they may have on Friday, but they didn't today. As we're getting into costs and expenses, let's talk about this week's economic news here. This morning's stuff, we talk about a bad beat. Normally, something like the ISM manufacturing prices paid doesn't get a ton of attention. It's minor compared to the overall manufacturing PMI, which is, the strength of manufacturing. That prices paid missed bad from a 59.5 to a 70.5. Prices paid are high. That is a leading indicator of inflation not being where we want to. After getting the PPI figures, it's pointing in a pretty bad direction as far as costs go. And along with that, the ISM manufacturing PMI is basically, I'm reading a headline here right now, U.S. manufacturing growth weakest in 7 months. So if manufacturing is going down, costs are going up. not ideal. What's your interpretation on what we saw Monday so far?
You're right. I mean, that's probably one of the biggest misses we've seen in a long time in ISM, to go up to a 70.5. I think it only compounds the issues we're seeing so far this morning with the markets. Obviously there is a lot of turmoil in the markets because the markets don't like the instability of war. Oil prices have shot up, and normally we would see, a flight to safety. We would see equities or bonds and treasuries boom during this time because there's obviously a sell-off in the stock market. But it seems to be that investors are putting more money into gold, silver, illiquid assets, maybe even just pulling money to the sidelines rather than putting it into treasuries, because there's enough negative data out there that says the treasuries might not be as stable as everybody's thinking anyway. So we're kind of getting hit with a double whammy today.
Yeah, it's weird to get hit on both sides. Usually there's some win somewhere, and we're getting none of them anywhere. And normally at this time this week, we'd be talking about, hey, first Friday of the month, dude, that's first Friday. It's non-farm payroll, dude. That's jobs report. Love the first Friday of the month. We're getting big data, important data, the data that everyone's been holding out for. With inflation not moving the markets, the last few big inflation figures, you got to think jobs will. And I find it interesting that non-farm payrolls previous came in at 130, which was about right for the season. Projecting at 60,000, we're really projecting some weak job numbers here. Not enough to take the unemployment rate up from the 4.3% to a tick higher, but that's still a pretty severe drop in NFP figures. Retail sales going down instead of being flat. I feel like we're set up to lose again here with no matter how, like either non-farm payrolls come in high and we're still at a low factor, but the markets are going to overreact, or they come in way low and the markets are shocked, which I don't even see an outcome here where everyone likes it. What do you think?
I think the only outcome we could see where investors actually like this is if we don't have a gangbusters jobs report on Friday and we see negative revisions to the December report, which is the BLS MO. Like that's their modus operandi, is to, quote big and then revise lower later. But we've also, let's not forget, we have seen BLS numbers in the past revised up. Now, wouldn't that be a shock to markets if we would miss on Friday? Let's say we create 100,000 jobs and then we see a revision up from December. And December is always the wild card because so many employers hire temporary positions for the holidays. My wife works in retail. There were so many additional employees added for the month of December that are now out. And so we might not see the negative revision. We might see that 130 number hold.
Yeah. We've also got, Thursday is going to be a leading indicator here. As you got challenger layoffs, jobless claims, and continued claims. The jobless claims could be interesting. This is the February report. We're only projecting 216, which is in line with the previous, but yet we're looking at adding, 60,000 jobs, like moving in the wrong direction here. So something's going to be wrong. I don't expect all these forecasts to hit. How the markets react, I think we're going to see a lot more, from the overreaction that we're getting this morning before we get to the end of the week. All that to say, the end of this week could also be dicey too. In fact, this week is setting up just to be a rough week all around with the way that the data is coming out. If we can't find some way to bounce off of these highs on the 10-year treasury yield, it could just keep compounding and snowballing. So nothing but good news coming from me. That's all the good stuff. Let's see what we got next.
Listen, this show is not about broadcasting good news. This show's about being realistic and giving the listeners a bit of insight into what we can expect this week. It's starting off to be a really rough week. Could we see this turmoil overseas calm down this week? Potentially. Is there probably a greater chance that it escalates? Absolutely. So I do think this week, buckle your seatbelts. Like we had talked about, I think I talked about on last Monday's morning huddle. I think there's a good opportunity last week to lock in. For those of you that took my advice, congratulations. For those of you that rolled the dice, I hope your clients were the ones that told you to roll the dice.
Yeah, I like Joe in the comments here. Thank you for the great tips. If you like it, lock it. And, got my stuff locked in last week too. We're sticking with that. Now, it's a little harder to tell someone like it, lock it when you just lost 35 basis points. But we've been around this too many times where you wind up on Wednesday thinking, man, sure wish I would have taken it at the start. I sure wish I would have got this protected before they got even worse. So that bounce back is not necessarily in the cards quickly. I think eventually we're always going to see things turn around, but how long does that take? It's anyone's guess. Greg, let's see where we are here as we look through the Fed funds rate. I feel like this is becoming more and more irrelevant this year.
It
No one
is.
really cares where this is going,
I mean,
which
it
is
is
weird.
crazy that we've added a fourth line to this.
Yeah, someone got a little tricky there in their late 2027.
But I mean, it's important to note that just a month or two ago, there wasn't even really much of movement at all into the 275 to 300. There wasn't much prediction there. And I do think this is entirely indicative of the new Fed chair coming in. And there are people that are starting to say, I think we're going to see more cuts.
Yeah, I mean, can the market sustain down to that 250, 275 range? It should be able to based on a normal market. Do we know what things are going to look like by the end of 2027? No. I think that's why a lot of the dot plot is focused on settling in that 300 to 325. But what this tells us is what we knew last week and the week before. The projection for the end of 2026 is to be down at 3.25%. We're going to hold this 3.75 here for another couple of meetings, it looks like. Do we move in June? At one point here earlier in the year, we were looking at an April cut as being the first cut. Now, 85% sure that's not happening. So we're kicking the can further and further on these cuts.
I mean, yes, but I also think that's 100% due to the Fed chair replacement. The markets are understanding at this point that Jerome Powell cannot stand this administration and will die on the hill of not making another rate cut through the end of his tenure. That's my thought on it. And so the markets have finally just admitted, okay, fine, we're moving our rate cut out to June because that's when the new Fed chair is coming in. Powell's not doing that. He will die on that hill.
Yeah, I mean, June, if we're lucky. June right now is a slight leader, but the way that things have been trending, it could be July. It doesn't matter if it's June or July, not necessarily. Keeping these rates higher for a little bit longer to try to rein in and get some control over these inflation numbers that have been kind of all over the place. It may not be a bad idea. We'll have to see. The focus this year is not on Fed rate cuts, though. It has been for the last year and a half. Now we're getting back into the econ data. What's going on with jobs? What's going on with inflation, like from a consumer standpoint? But moving around the Fed funds rate, we're talking quarter here, quarter there. Not going to be huge shifts, not going to make major impact. But hey, we'll see where we get later this year. For right now, putting the target on that June, July timeframe. But let's look and see, what looked good. Oh, that's so, and it's gone.
Hasn't updated yet this morning, but we'll see an update.
It's funny. I've showed this to a couple people last week. I was like, every time we hit this low spot, we get this little clip up and we get this pop. And I know at some point we're going to get this pop, but hey, let's go. Honestly, we sat in this 6.0-ish range longer than we had before for all these other boosts. So, are we popping up to what? 607, 608?
Yeah, we'll split that difference again, and we'll see where the rest of this week takes us. And this is what I said a couple weeks ago. This 6%, like, if we can crack it convincingly, we're in a good spot. Like, we got room to run down. But that floor is bouncy, and we just keep finding a way to bounce off of it. I mean, whether it's the administration, whether it's whatever, that is just a bouncing floor. We keep finding it.
It is. And, two things have to happen to break that 6%. One, we got to get there on, mortgage yields, but mortgage yields have been okay. The MBS securities pricing has been fairly resilient. But like we were talking about before the show started, we got to get that 10-year treasury under 4%, and we need to hold. Yep. And, at one point late Friday, I'm looking at C3, 3.95. I'm getting all excited, like getting some distance away from that 4%. And now we're back close to 4.43. So it's like, okay, it is what it is. We're going to have some room to go. It is, promising that even just looking back from December to now, that you can draw a line through the averages here and see that we are moving better. We are moving in the right direction. A blip today, a blip this week does not necessarily restart our direction. We have not been coming up and going high enough to really change this overall lower trajectory. And that's good news for anyone forecasting throughout, the spring buying season into the summer. we should still have rates down in this low near 6% mark. And cool. So we're at least holding enough that I'm trying to make myself feel better with what's going on today.
I agree. I think, in the words of Barry Habib, mortgage rates never move down in a straight line. Imagine you're going on a down escalator with a yo-yo. You're going to have bad days where it's coming up. You're going to have good days where it's going down. Well, we are still in a very convincing downward trend on the 10-year. Whether this is the catalyst that breaks us out of it or not is yet to be seen. I think a lot of that will depend on the data that comes out this week. If we see really poor data this week, we could find ourselves in a catalyst that breaks us out of our downward trend. Whether that's going to be short-term or long-term, we won't know yet, but it's going to be a big week for data.
All right. So I think we're done with our slides here. I got a question for you, Andrew, Greg, if you want to bring us back in together.
What you got?
So there's something that I was told in my my freshman, one of my music classes in college, which I guess 22 years ago now. The professor said, why war is great for the economy. And, this was 2003. So he's going back, 80 years, and how, major war changes the economics of the nation, changes spending. It pops us out of a recession. It gets things going. But over the last 20 years, as mortgage people, as we watch and see what typically happens here, we can almost every time point to flight to safety. Can you explain a little bit what flight to safety means and why we're possibly not seeing that this time?
Yeah. So flight to safety is people moving money out of equities, out of the stock market, which is when you see a big tumble in the stock market. Typically, you'll see that money invested into treasuries. Why? Because treasuries are long-term, very secured investments. It's that flight to safety. They take it out of the risk of the stock market into treasuries. We're not seeing it right now, and we're not seeing it at all. And I do think there's just too many unknowns for investors. Whether we're walking into a recession, there's still talks of recession out there. The labor market seems to be cracking. There's a ton of risk on both sides of the table, and this is one of the first times in a long time we've seen the risk on both sides. And where we're seeing money being put, and correct me if I'm wrong here, but I'm seeing a lot of money being put into hard assets, the price of silver, the price of gold. I literally had a guy call me last week who's got over $1 million in silver and trying to do an asset depletion loan on it. And I had to break the news to him that that's a tough one to do an asset depletion on. But I think people are genuinely scared of equities and of treasuries right now.
Do you feel like historically, especially over the last 20 years or so, anytime there's global instability, world markets look to the 10-year treasury bond? Do you feel like with our current administration and the way things have changed in just the last few years, that U.S. bonds are not as highly sought after, that they're not the same type of safe investment vehicle as they've been viewed, in the previous 70 or 80 years?
I would agree 100%. I think, whether tariffs are the right thing or not, I think we have essentially pissed a lot of the world off. And let's just be honest with it. And I definitely think, there's moves by mega player countries to take the world off the U.S. currency as the base. There's those conversations weren't happening 20 years ago. And we are now.
Some of that is just the world catching up. The U.S. was so dominant for so long as an economic powerhouse, and now you're looking at where is the future going, things like computer chips, AI, different sectors that are being, worked in other areas completely, data centers that can get cheap electricity in other parts of the world. It's just kind of changed the fundamentals of global economics. But to your other point, no one, a lot of these other countries don't want the U.S. dollar to be the standard. That's been a way for the U.S. to essentially control things, as we can manipulate the value of the U.S. dollar with the way that our treasury works, how we're buying things, issuing, these portfolio bonds. It's interesting. This is the first, I think about the last big skirmish when Russia invaded Ukraine. We saw a flight to safety. We saw bonds, react how we would expect to. And with this, I don't know if it's a matter of we don't really know what to expect with the Iran conflict. We don't know exactly how long this is going to take. Maybe, a prolonged campaign could throw some money into bonds, Do we know, where things are going in global stocks yet? Too many unanswered questions right now, but I know my social media was filled with mortgage people over the weekend expecting these bonds to tumble, and we got the exact opposite. So everyone's sitting here holding the bag, trying to figure out what happens next.
And I
Best thing
think,
you can do is take what you get and do the best with it. Like it
and
if
I
you
think,
like it. What do you got?
yeah, I'd wrap with this on. I think there's also something to be said about the amount of debt our country took on during COVID.
Mm-hmm.
As a percentage of debt, was one of the leading countries in the world, developed countries in the world, that increased debt on a percentage basis during COVID. We printed trillions with a T, and that's plural, and that devalued our currency on a very big level. And I think you couple that with the the is that the right word, unsurety of this
Uncertainty?
uncertainty, yeah,
I
uncertainty.
got you, bro.
I'm like, I couldn't catch the word there. The uncertainty of this administration, because it is kind of a wild card. Like it's no tariffs, it's 10% tariffs. No, it's 15. Hey, it's going to be 50. Hey, it's going to be 90. Hey, it's going to be down to 20. There's no baseline for any certainty right now. And you
Mhm.
couple that with a massive amount of debt issuance, doesn't surprise me that the world is questioning the U.S. as the basis for everything.
Yeah, volatility plus uncertainty plus global conflict means we don't really know. Money's going to move. Big money's going to make their pick. Maybe that's gold, silver, oil, stocks, bonds, whatever. And the other money's going to follow. There's not really a playbook for this. There's billions of dollars to be made in the secondary markets, and that money is going to influence the other money, which is going to influence what we do on a daily basis. If we knew exactly what was going to happen and we had that kind of money, we'd be billionaire bond traders. But
Agreed.
instead, we're sitting over here helping people, doing as best we can, trying to help everyone explain this. No, what do you say to your partners? What do you say to real estate agents? What do you tell borrowers when they say, "Oh, well, I'll wait for this to bounce back down"? Like, well, now you know why it may not, why it may be some time, and why we need to, look at exactly what we have, take it for what it is. If it makes sense, it makes sense. But with as many years as Andrew and I have spent studying this, if we can't tell you where this is going or what's going to happen even on Friday, certainly can't project out 2-3 months from now right now. So we'll wrap with that. Sorry for all the bad news. Hopefully you have a better understanding of what's going on and why. It'll be interesting to come back after a crazy week like this and kind of deconstruct what that looked like. Hopefully we get some good news later in this week, but we'll be back next Monday to let you know what's going on and what we can expect going forward. Thank you, guys.